Hi friends, I'm back with one more video. So today we will be discussing the difference between the debit spread. For your reference, I've written here debit spread versus the credit spread. Okay, so before watching this video, I would recommend you to just go to my YouTube channel, that is Hybrid Trader. Right, in the playlist section you will find a video on end-to-end series. Yeah, end-to-end series on debit spread. So there are like basically 15 videos, right? If you want to know more about debit spread, the complete end-to-end, how to mitigate the loss, how to deploy, what strike rate we need to select, what is the premium we need to select, how to get the best risk to reward, okay, how to lock your profit. So we have almost like 15 videos, and I'll keep updating this series. Let me take you back to, so today we will be discussing about difference between debit spread and credit spread from almost all the aspects, right? All the parameters. Okay, this is my debit spread. I'm showing you. See, debit spread. Whenever we go for the debit spread, we go for call because we are bullish of the market, right? So we deployed 34,800, and then we sold 35,300 by maintaining like 500. So we'll be not discussing about the strike selection because I've explained everything in this video, in this series. Okay, so this is your debit spread, which has basically 1:3. If you look at the risk to reward, it has 3,000 loss and 9,000 profit. It is 1:3. Okay, so what is credit spread? We buy, we sell one, we sold like 33,800, and we bought one like 33,300. Looking at the risk to reward, this is opposite of your debit spread. This is a credit spread. Okay, 3,000 is your profit and 9,000 is your loss. Okay, check, pause the video and check. Okay, for the debit spread you have 9,000 profit and 3,000 loss, but for the credit spread you have 3,000 as profit around and 9,000 as loss. But the differentiator here is the POP, right? The probability of profit is 70% in your credit spread, whereas the probability is only 27% in your debit spread. See, I'm not biased here. Okay, I'm not biased to credit spread or biased to debit spread. I'm just explaining you the differences so that based on your trading style, based on your market view, your trading, your risk to reward or your risk appetite, you need to deploy. Okay, so now 27% is the POP in your debit spread, whereas it has 70% POP in your credit spread. So don't you think there is a huge difference between 27% and 70%? So any strategy which has 70%, I think we can just rely on that strategy, provided you know some basics, you know some adjustments. All right, but 70% is a very good POP. All right, so now let's check the this thing. What do we say? Margin. See, margin required is 20,000, but for credits, for credit spread, somehow it is showing 8,000, but this is not 8,000. This will be like between 25,000 and 30,000. So for your reference, I've deployed in Opstra also. See, the same trade I've deployed in Opstra. Opstra is showing the estimated margin of almost like 30,000. Okay, so just a disclaimer, this is not 8,000, this is like 25 to 30,000. All right. Okay. Now, so what did we discuss? We have discussed about risk to reward versus your POP. Okay, now what? Okay, see, check the payoff graph, right? Check the break even is very important, friends. Break even is very important in your debit spread, right? You will get into profit only when the market makes a move of 1.9%, close to 2%, right? What I meaning to say, you will get into profit only when the market makes a move of 1.9%. Check the black box. Okay, check the black box. Now 1.9%, then only you will get into profit in your debit spread. But whereas your credit spread, right, check the break even. The break even here shows minus 1.72. This is very important, and it shows minus, but whereas in your debit spread it shows plus, positive, right? Meaning in your credit spread you will get into profit if the market makes a move from here. If the market makes a up move from here, anyways you will get into profit of 3,000. Even if market makes a down move, even if market goes against your view by 1.72%, you will be still in profit. Hope you're getting my point. Even if your market, even if your view goes wrong, see, check the green box. You are safe till here, this break even, right? Your loss will start. So check the expiry loss. Check the expiry loss on the expiry. If market ends at 33,700, still you will be in profit, right? Market made a down movement of almost like 1.7%, but still you are in profit. You're getting the crux, right? See, you deployed credit spread with a view of market going up. When market goes up, no doubt you'll get into full maximum profit. But the catch over here is like, even if market makes a move of 1.72% downside, you will be in still profit. If even market expires a year, right, 33,940, check the black box. Expiry day, you will get a profit of 2,800, which is your maximum profit. Even if market expires somewhere here at 33,760, you will still get with your 1,800 profit. Even if it expires at the break even, you will be still at profit of 308, right? See, I'm just overing the market to down, I'm simulating. Check the expiry date profit, it is still in green, it is still in, though it is reducing, it will not reduce till this point, but from here it will reduce. That's it. From 2,800 it will reduce to 2,308, even if market is falling. This is the beauty of credit spreads. See, 1,300, even if the market is falling, right, you are into 3,000, you'll start getting into losses only when your break even is breached. See, and even the loss, though your max loss is like 9,000, but your maximum loss will be this area. Once this 33,300, this one, your breach 33,300 is breached, this area. But from this area till this area, your loss will gradually, right, increase, but this will be your maximum loss. See, check, I'm just rolling over, right, from 2,195, right, it slowly increases, right, 2,443, right, see, slowly expiry, right, 2,693, right. So this area, from this area till this area, meaning, let me show you what I mean to say is, from this area, okay, let me take the white, from this point till this point, your loss will gradually increase. This will increase gradually, meaning, let's say you have like 2,000 loss here, right, this year it will be like 2,500, right. As and when the market keeps moving, the loss will increase, but from this point, if the market keeps going, this will be your maximum loss area. Pause the video and try to play around with the obsta if you're not able to understand. Okay, let me take you back to sensible. Now, we have discussed it. If the market goes up, you'll get into profit. If the market even comes down based on your profit, until I would say until 1.33%, you will still get maximum profit, even if the market makes a down movement. All right, and this area, right, this area until your break even. Now go back. Let's go back to your debit split, right? So we have deployed a debit split in a view of market going up. All right. So for you to get into profit, market has to make a move of almost 2%, like 1.9%. But let's say market keeps falling from the day of deployment. Look at the expiry day, right? That will never show you. Look at the expiry day profit. That will never show you green, because right, we have deployed the debit split with a view of market going up. So I'm just simulating the market. Look at the black box expiry. Your maximum loss will be like 3,175. Your maximum loss, it will never show in the green side. But whereas in your credit spread, even if even if the market keeps falling, right, you see green color profit on your expiry. All right, what I mean to say is, sorry friends, what I mean to say is, like, in the debit spread, your market has to go up, then only you will get into profit. But in the credit spread, no doubt, if the market goes up, you will get into full profit, and even if the market comes down, but still you will get into profit until your break even of minus 1.72%. So don't you think 1.72% is a decent percentage? I mean, though your view goes wrong by 1.72%, still you will be into profit, and your loss will start only when the market falls more than 1.72%, and there you can go for your adjustments. So friends, I'll come up with a series on credit spreads also, wherein I'll discuss about all the adjustments, but today we will be discussing only about the difference between your debit and your credit spread. Okay, right now, so we've discussed about POP, we have discussed about break even. Break even is very important. It all depends on your view now, right? So let's say the capital deployed is 20,000, right? What is the percentage? What is the returns, right? It is almost, don't you think, 50% in your debit spread? So are you targeting for 50% for 1 week? Right, market is not ATM, right? We should not be trading it as gambling, right? This maximum profit is 50% on the capital deployed of 20%, which is very huge, right? Basically every successful trader, they look for maximum 1 or 2% per week, at max 3%. Even 3% is very huge. Okay, so don't you think, if you're targeting for 9,000, if you're targeting for 50% on the capital deployed of 20,000, I think we are doing something wrong. So whenever we get like 2 to 3% either in your debit spread or in your credit spread, you have to exit the trade. You have to exit the trade, because 2% per week is like 8% per month, right? Which will be like 120% per year, right? Close to. So are we targeting for 120%? I'll just leave it to you, friends, because whenever I trade, right, whenever the basically all the successful traders, forget about me, right? I'm just exploring. All the successful traders will have the realistic expectation of 2% per week or 3%. But now I'll show you one magic, right? If you're targeting for 2%, why should we deploy debit spread? Because your profit will start from once the market makes a move of 2%, right? Rather than that, why don't I go to credit spread, right? Even if the market expires here, I'll get my 2,800 on a capital deployed of 30,000. I told you, right? This is 30,000, which is almost 10%. 10% is also a huge profit for weekly. Even if I see like 1,500 profit, right, on a capital deployed of 30,000, which is like 5%. Even 5% is huge, right? So friends, do not take me wrong. Right, I'm a very conservative trader, and also I want, right, until and unless we are conservative, if you take, right, if you are a very aggressive trader, yes, still you can go for credit spread, right? You can target for this maximum profit. But the beauty of credit spread is, if the market goes up, you will get into 10% profit. Even if the market comes down by like 1.4%, you will get your complete 10% of the profit on the capital deployed. Even if your market comes down by like, let's say, 1.5%, you will get 1,300, which is almost like 5% of your capital deployed. Even if the market comes down to your break even like 1.68%, you will be get at a profit of 308, right? Which would be like maybe like 1 or 2%, right? Don't you think? 1 out of 30,000, yet 1%, right? Still you're getting 1% if the market is making a downside of 1.72. Friends, I'm showing it only with one lot. If I increase this to 10 or 100 lots, you will see the magic, right? Maybe for you this through 2,800 profit will be like very less, but check from the percentage perspective. If I increase this to 100, right, I have to increase 2 zeros to here, right? Your 2,800 will become almost like 2 lakhs, right? 2 lakhs 8,000, right? I'll just leave it to you. It all depends on your risk appetite, your trading style, right? Rather than deploying the debit spread and focusing on the center, if your expectation is like to get like 3%, 4%, rather than deploying the debit spread, go for credit spread, right? Because, right, though your profit shows less, right, when compared to your debit spread, do not get influenced by the maximum profit. Yes, your maximum loss is more here, your maximum loss is very less, but check the probability is only 27% in debit spread, but your probability is 70%. I'm not biased, I'm just telling you, because my all-time favorite is debit spread. Honestly, friend, my all-time strategy is debit spread, but I'm still showing you the credit spread, right? Why not to go for credit spread if you have a very strong view of market going upside or maybe sideways market? But in debit spread, if the market stays where it is, you will get a loss of 3,175 on the expiry day. Check the black box. Even if the market goes like 1% on the expiry, if it expires by going 1%, you will still have 3,175 as the loss. Even if it goes to your break even, still you have a loss of 3,175. Even if it comes even if it is goes like 1.82%, still you have a loss of 675 on the expiry. Don't look at the green color, look at the expiry. But whereas in the credit spread, if market stays where it is, you'll get with 10% profit, that is 2800. If the market comes down by 1.35%, you'll get with a profit of still 10%, that is 2800. If market still comes down by 1.5%, still you'll be making 1800, which is like 5% of the capital deployed. If your market comes at break even, still you'll make 1% of 300 on a capital of what do you say, 30,000, right? If it starts falling, so then I'll blame your price action, or maybe there is some severe issues with the market, right? So then you have to get in with your adjustments, right? Believe me, I'll come up with credit spread series also, wherein I'll be explaining you all about the credit spreads adjustments, right? So we have discussed from the POP perspective, from your break even, from your maximum profit, from your maximum loss, right? The margin deployed, what will happen if the stock, if the price goes up, what will happen if the price goes down, right? We have seen all the examples, friends. I think this is sufficient for you to come to a conclusion whether you have to go for debit spread or you have to go for credit spread. It all depends on your view, it all depends on your trading style, it all depends on what expectation of profit you have on the capital deployed. If you have a firm belief that market will make a move of 3% by the expiry, then go for debit spread, because you will get a profit of 9325. But whereas if you go for credit spread, you'll get only 2800, irrespective of market making 10% upward. But in your debit spread, even if market makes 3%, right, you will get a profit of 9335, right? But predicting the market is very tough. I will not say tough, it is impossible, next to impossible. No one can even predict your market. It is all about view, right? It is all about probability, not about any certainty. Like everything, there is no certainty in the stock market. Everything is uncertain. It's all about finding the high probable trades or finding the high probable opportunities, right? I'll just leave it to you. I'm not in biased of debit spread, or I'm not in biased of credit spread, right? I've told you all the differences. And friends, one more thing is like, see, I've taken this 1:3, right? Intentionally I've taken this 1:3, and intentionally I've taken 1:3, just to just to demonstrate you, right? You can go for 1:1 also with your debit spread, because I told you, right, whenever we go for debit spread, we need to have at least 1:3. Okay, let me show you, right? I think we have covered everything, right? We have covered everything, so let me show you. I'll clear this trade, I'll go to this sensible, I'll deploy a bull call spread, I'll take the sensible. Now see, this is almost like 1:1, right? Because based on the strike selections and based on the premium selection, I'll go here for the credit spread, right? I'll clear this thing, and then I'll go for bull put spread, right? Check the difference. Now you have 1 is to almost like 1 is to 1.25, right? 1 is to, I would say, 1.2, almost like 1 is to 1. So even here you will have like your risk is more, your reward is less. Check the difference. Even if the market falls by minus, this is a very important, even if market falls by minus 4.46, still you will be like in profit, right? But whereas in your debit spread, market has to go like 0.73% for you to start seeing the profit, but market has to go to 1.53% to see the maximum profit, right? This break even is for you to start seeing the profit. This break even doesn't mean that you will get into this maximum profit. Break even is this point, right? For you to see this maximum profit, market has to make a move of 1.60%. All right, so what I mean to say is like the strike selection, the premium selection, all about risk to reward, right? The strike rate, it all depends on your style. See, I've taken, see, if you look at my debit spread, this is my debit spread, right? I've taken intentionally this strikes because I wanted to have almost 1:3. Don't you think like I have a ratio of 1:3 in my debit spread, right? If I lose 1 rupee, I'll get 3 rupees, right? But whereas in the credit spread, see my risk to reward, it is 1:0.29. So if I lose 3 rupees, I'll lose 9 rupees, right? See the risk to reward, right? 1 is to 0.29, but whereas my debit spread I have 1 is to 3. This is a differentiator. But check the POP, it is only 29%, but here it is almost 70%. So now you have to decide. More or less it will take the same capital, right? 29,000 year and 17 20,000 year, but check the profit. You'll get huge profit in debit spread, but market has to make a move of, right? How much? Market has to make a move of almost 2%. See, 2%. Market has to make a move of almost 3%. Then you'll see 9250. But in my credit spread, right, to have this profit, market doesn't have to go upward. Even if the market expires here, I'll get a profit of 2,800. Even if it expires here, right? You're getting my point, right? So I'm just reiterating many times because this is very important. So in case if I've missed out any important points to be discussed, I'll come up with a follow-up session. But believe me, friends, I'll come up with the credit spread series. Right? Even I'm planning to have more hands-on experience onto the credit spread. So stay tuned for my credit spreads. Friends, please, please, please subscribe my channel and also please share with your friends. It takes 1 minute for you to subscribe. All right. Thank you, friends. Thank you for watching my video.